Hi, and welcome to Random Rogers Big Picture for the week of February 3rd. Interesting week, up week, so that's good. A couple of things on the agenda to talk a little bit about ETFs, maybe talk a little bit about the market. So ETFs, Claymore is liquidating, I believe it's 11 ETFs, a whole lot in this 11 of Me Too type funds, lots of cap size and style products that they're blowing out. Never gained much traction. You can look at Index Universe for the details, but basically most of them never attracted any assets, and so they're getting rid of them. This is something I wrote about a long time ago, that, you know, bring all the ETFs you want. There's no such thing as too many ETFs. The market will vote, and the market has voted. These 11 are going. There'll be more, I imagine, and just kind of an interesting development. 11 all at once is kind of big. A couple of years ago or so, the SPDR people, State Street, closed out that OOO fund. A long time ago, iShares actually closed out a couple of subsector funds. I think that may have been in 2001. I'm not sure, but there'll be more of it. It's not a big deal. If you own one of these funds, you may have a tax consequence. I would say not to hold it till the end. I would say to just blow it out if you own something that's going to get closed. So that's that. One other thing from Index Universe that I thought was interesting was Macro Shares is coming back to the table with a new product. They're going to try again. They're the ones who made the oil shares that really had some rough going with all sorts of the poster child of unintended consequences, and so they're back. This is interesting. I don't know if this particular product is going to work, but the concept is fascinating. It is healthcare inflation or medical costs, or I'm not sure how they're titling it. I saw two different names on the Index Universe site, so whatever. Basically, the up share, if health costs are going to go up, the up share will go up. If health costs are going to go down, then you want to own the down share. The down share is the thing that would appreciate price-wise if costs go down. This seems like a fairly one-way trade. I'm leery about unintended consequences. Macro shares kind of needs to prove they can get one right. But conceptually, this is fascinating. This is something that I've kind of touched on before, not health costs, but other types of things. New Zealand timberland is something I'd like to see. Not stocks that are in that industry, if there are any, but the actual industry of timberland. It's kind of like, all these smart people that own timberland in New Zealand, Jack Meyer, Julian Robertson, and so on. So something like that. Or another example that I've used a couple of times before is one way or another indexing and then owning from Malaysia rubber and or palm oil. Something like that. It's buying into the economy as opposed to buying into the stock market. When there's a crisis, the next time there's a crisis that does impact Malaysia, for example, I think the rubber ETN, how do you like that? The rubber ETN will have a different reaction than the stock market might. So hopefully this thing will work as opposed to the oil shares, which, woof, woof, woof. Anyway, hopefully it works, because if it does, then that will open the door to more innovation. Clearly, whether it works or not, the idea is innovative, and the extent that we may collectively need to move away from stock market investing if we devolve into a 6% world instead of a 10% world, if you know what I'm saying. Okay, and then I'll just talk real quickly about the market. Pretty good week for the market. Feeling good type of rally. I expressed some concern about, starting to question whether or not my call for a normal bear market is wrong, whether that was too aggressive and this may be a shallower whatever. I don't know what you would call it if the bottom is truly in. I still don't think so. Feel good rallies, if you're long, they feel good. If you're not that long, and depending on the context, I'm probably, around 70% long. I think that would be a good estimate. Feel good rallies cause you to question whether you're not long enough. And so that's pretty healthy. As I said on the blog Friday, I didn't do any trading on Friday. Actually captured the effect somehow. A couple of things bounced back pretty hard, so that's always good. But this is not a time to go, in my opinion, to go hog wild and, to get sucked in. Depending on what you watch, you'll get a lot of, real passionate types of commentary, from my boss and also from some other people. Don't listen to that. Just stick to your plan. Someone will have to comment about, should he sell his double short and take the loss? And my answer, was, I don't know what you should do other than stick to your plan. Hopefully you had something in mind going in and just stick to it. Seeing someone get very excited in either direction on TV or reading a post or whatever, and making a portfolio shift based on something like that, that's tough to do. If you sat down and crafted a plan at some point, chances are you had something in mind, and it probably wasn't based on something stupid. And so changing in the middle of the event, I don't think that's a great idea. Nothing wrong with second guessing and re-examining and spending a little time on some due diligence, but rushing to make a change, if we are underway for a 30% rally and you don't start moving for another 5%, if I take off my shoes and socks and I count, I think that still means you get another 25%. But maybe I have that wrong. Anyway, I'm a Patriots fan. Some of you may know I grew up in New England, so rooting for the Pats should be a good game. Have a good weekend.